Well, the market's ending higher today, as you just heard from John, as investors jump in on the dovish turn in Fed policy, reignited momentum in some of the big cap tech names. Will the stabilization continue into December? Well, let's bring in JPMorgan Asset Management Portfolio Manager Phil Camporeale and Wells Fargo Investment Institute Senior Global Market Strategist Scott Wren. Gentlemen, great to have you here. Phil, you're on set. Welcome. I'm going to start this conversation with you because one of the things that stood out to me in your notes is this idea that 2025 has been a return to normal for the markets. What does that mean?
Yeah, it means that global diversification doesn't just own 7 stocks in the U.S. and that fixed income in the portfolio could actually work. The dollar doesn't go up every year, which obviously impacts taking risk abroad. But most importantly, we've gotten back to normal on the rate side. I stare at the 10-year note every day. I think it's one of the most important indicators. And as you know, last year, the Fed eased the federal funds rate, technically, but tightened policy because long-end rates went up, which mean more to the U.S. consumer than the federal funds rate will ever. So we took the opportunity last week to add to risk in the sell-off because of that fundamental story, Morgan, that we think remains intact. We have double-digit earnings growth in 2026. We got a little pullback in multiples. We went from like 23 to 22 times, so we got a little pullback there. But most importantly, it's this interest rate environment that's cooperating. Rate volatility at its lowest levels since the Fed started their hiking campaign back in March of 2022. And the Goldman Sachs Financial Conditions Indicator also showing easy conditions for the U.S. consumer. So I think it's kind of a green light to take risk on both sides of the balance farm.
Okay, I want to get Scott in this conversation, but first, 4% on the 10-year?
Yeah.
Does that feel healthy? Does that feel normal? Is that where it should be? It
feels totally normal. And as history has proven, that the 10-year note should be something that looks like nominal growth, real GDP growth plus inflation. If you have 2% GDP growth next year, you have 2 to 2.5% inflation next year, that puts the 10-year note exactly where it should be.
Scott, how do you feel about where the markets are now? There's been a lot of swinging around with this AI trade. Can you believe that the markets are trading on fundamentals here and not priced, not for perfection because it was there a few weeks ago, but a little too close to it?
Yeah, John, I don't think the market's priced for perfection, but certainly hoping for a lot of good things to happen, which, let's face it, this AI spend, it's going to keep going. The companies that have been doing very well, making a lot of money, seeing a lot of cash flow, that's going to continue to happen as we go through 2026. And, really for us, and you and I have talked before about this, I mean, we're leaning towards stocks. We'd like to lean more towards stocks. If you would have asked me 3 months ago if we would have had a 10% pullback by now, I would have said, absolutely. But we just haven't. So, we took advantage of the pullback back in April, and that's a long time ago now. We continue to not sit on our hands, and basically it looks to us, we cut back to a neutral on the technology sector. We had been overweight that for a long time. We did the same thing in communication services. So we've trimmed there. But if you think about it, those two sectors together are pretty close to 50% of the value of the S&P 500, even when you're even weight. So that's a load right there. And we've been moving funds into, industrials, utilities, financials. Those are really the sectors that we've been buying.
I want to ask you about that. Can you really diversify in this market into utilities and industrials when so many of them are starting to get influenced by the AI narrative as well? Do you have to go elsewhere to truly diversify out of the AI impacts?
I think you do because, and really, John, to be honest with you, I mean, we're moving into those sectors because of their AI impact. And so, it's just kind of a cheaper way to get some exposure. There's a little bit of diversification there. So I think you need to still lean toward, technology, obviously, AI, obviously, but you need to get a little bit of a different angle on that. And that's what we're really trying to do. I don't think you want to diversify too far away from the companies that are really growing and have the potential for cash flow and earnings, because I don't think it's going to be a whole heck of a lot of difference over the next year than it has been the last year.